Welcome. In any financial situation in the real world, the interest rate is the percentage charged or paid for the use of money. It is charged when money is being borrowed and paid when it is being loaned. The function of banks is to grant loans or hold deposits. So they're either going to give you a loan or hold your money. That's how they function. Banks convince people to make deposits by paying interest to them. They are paying depositors for the right to use their money. So you invest in a bank, they pay you some portion yana just for saying thank you for allowing us to use your money. They then use that money to grant loans. So that's the same amount that they paid you for the right to use. They're going to take it and give someone a loan, right? Mind you, they are holding your money. They are using it also to give other people loans. The interest rate for borrowers, it's higher than the interest rate for depositors. You are a depositor, there is someone who is a borrower. So if you are a depositor and there is a borrower, so I'm going to use D and B. So the interest rate for the borrower is going to be higher than that of a depositor. So if the interest rate of a borrower is higher than that of a depositor, it means they said thank you to the depositor by giving them a small portion. But the borrower, they're charging them a whole lot of money. But the money, the source of money is the depositor here. You see how banks are being smart. They're just convincing this depositor, no, regard this 5,000 rand, we will give you 5,020 rand. But the depositor, they're saying, the borrower, they're saying, we'll borrow you 5,000 rand, because the borrower doesn't know where it comes from. It actually comes from the depositor. So the borrower is like, okay, I need 5,000 rand. They're like, no, it's fine, we have it. We'll borrow you. But when you bring it back as 5,200. That time the depositor was given only an additional 50 rand or 25 rand. But this one, the borrower, they want 200 rand extra. So you see how they are making money, because now the difference between those two values, it goes to the bank, and it's a positive one. So the bank is winning. Okay? The interest rate for borrowers is higher than the interest rate for depositors. Banks want to charge as much interest as possible on loans and pay as little as possible on deposits. So on the investment, they want to give you as low as possible, but when it comes to the loans that you ask for from the bank, they want to charge as much interest as possible so that they can be more profitable. It's what we do, I think, on a daily basis, normal people, but the bank just does that at the larger scale. So that's how banks are being more profitable. So there are two main types of interest rates that you were introduced to in the previous grades. Hopefully you were, but if you were not, don't worry. We will definitely make it make sense to you as well. If interest is calculated using only the original amount of money saved or borrowed, then it is called simple interest. If the interest is calculated on the original amount plus interest already earned, then it is called compound interest. That's the only difference between the two, compound and simple interest. So we have two types of interest, but in the real life situation, we know that interest basically refers to the amount that is being charged or paid for the use of money. That's the bottom line you need to understand. And then whether or not it's been calculated on the original amount only or on both the original plus the accumulated amount or the interest that you have already earned, then it's going to be called either compound or simple interest. So that's how the difference goes. Those are the basics you need to understand. Compound interest is used for long-term loans and investments, while simple interest is being used for short-term loans or investments, right? That's the difference between the two. Okay? 5 years or more years, that's when we're talking about a long term. When it becomes less than that, it's more of a simple interest. If the duration for this discussion or the commitment is where someone has been borrowed money or investing money. Okay? Let's look at this simple example to understand this. The rest you will just read, it's fine. So suppose 5,000 rand is invested in a bank. Ne? Let's calculate the accumulated amount after 3 years. If the interest rate is 3.75% per annum, if the per annum simple interest, right? B, it's if we go with compound interest. A, if you're going in simple interest. So the difference is gonna be here. After 1 year, if you're looking at simple interest, right? Let me just write this: compound and simple. So after 1 year, if you're going with simple interest, you will just add 3.75% to the 5,000, then you end up with 5,187 rand 50 cent. After 2 years, you will have 3.75% of 5,000 again, which is going to give you 187 rand 50 cents, and then you add it to that accumulated amount, and then you end up with 5,175. But with compound interest, after 1 year, it's going to be the same amount as it would have been in a simple interest. But after 2 years, it's a bit different, because now the interest is being calculated on the accumulated amount. You see, so this 5,187.50 plus 3.75% of that accumulated amount, which is 5,187.50, it gives you 5,182 rand 3 cents, which is higher than this one of simple interest. As you can see, this is higher because the interest is being calculated on the already accumulated amount. So you're adding 3.75% of the accumulated amount. In simple interest, you're always adding the percentage of the original amount, which is 5,000 rand. That's what we started with. So you're always earning interest on that. You don't earn interest on the accumulated amount. That's the difference between the two. Okay? You see, after 3 years as well, you are earning 3.75% on the 5,000 rand in simple interest. But in compound interest, you are earning 3.75% interest on the accumulated amount. Now, the accumulated amount is this: 5,382 rand 3 cents. Hence, it becomes a total of 5,583 rand 86 cents for compound, while for simple interest, it becomes a total of 5,562 rand 50 cents. The difference here, it's mainly with the fact that in simple interest, you are earning interest only on the original amount every year. So you see, you earn 187.50 after the first year. After the second year, you still earn 187.50. After the third year, you earn 187.50 again. But with compound interest, the first year you earn 187.50, the second year you earn 194.53 cents, and in the third year you earn 201 rand 83 cents. So the amount of interest you keep earning keeps going higher because you are earning it on an accumulated amount, which is greater than the original amount. Hence, the interest that you are earning keeps going higher. Hence, even the total accumulated value at the end of the 3 years, it's higher than it would have been in a simple interest. Because in a simple interest, you always earn the same amount of interest, because it's always calculated on the original amount, which in this case is 5,000 rand. That, in a nutshell, gives you the difference between simple and compound interest. So it's only based on how the interest is calculated. The difference between these two types of interest that are being earned is based merely on how the interest is being calculated. Is it always on the original amount, or is it on the accumulated amount at that point in time? Then you can tell that it's compound or it's simple. That's how easy it is to differentiate between the two types of simple and compound interest, or the two types of interest rather. Thank you. I hope you understand. If there's anything that's still not clear, let me know, then we can simplify it. Thank you.